When fear is at its highest, the market overlooks any positive aspects, like any positive aspects. It becomes blind to opportunities because all it's focused on is the fear. So it's counterintuitive, but if you take a step back, and I mean, it's not to dismiss like some of the uncertainty, like the uncertainty is real, like it's legit, like it's real uncertainty. Nobody really knows how it's going to play out. But at the same time, if you take a step back and think about it from a long-term investment perspective, these are the moments when a lot of great deals or opportunities start to pop up.
Yeah, ayy, the market hustle, helping you to succeed, teaching like nobody else. Financial empowerment, giving you strategies for generational wealth. So you can start helping yourself. More money for you to be getting. This the moment for you to be winning and be living financially independent.
Market Hustle community, welcome to episode 45. For those of you who are new here, my name is Josh. I'm the guy behind the Market Hustle. And for those of you who are returning, welcome back to another great episode. It's been a pretty busy week on my end. I've been making some new improvements to my money mastery program, just helping people break down different diversification methods, and also working on getting some new incredible guests scheduled for this podcast, for future podcast episodes. So really looking forward to that. Today, we got a special episode lined up for y'all. We're going to be talking about the current market choppiness we've been seeing. If you've been watching the markets, you know it's been quite a roller coaster ride lately, with the S&P 500 recently wiping out nearly $4 trillion in market valuation, briefly dipping into correction territory due to the tariff war, causing a lot of uncertainty. So we're going to be covering this. We'll also, in the second half, be covering a little bit of questions that we got from a recent IG Live. Everything from where to start as a complete beginner, what to do with student loans, and even some Roth IRA strategies. So looking forward to that as towards the end of the podcast. Before we jump into that, let's go ahead and check in on our two lovely co-hosts. We got the team here today. Let's check with Bafi first. Bafi, how are things going in New Jersey?
Things are great, man. It's been a little while since we hopped on here, so super excited. A lot of things happening in the world, in the market. Life is good. Can't complain. My best friend is actually getting married in August, and so he made me his best man, and so super pumped and excited for it. Really an honor and a blessing to be able to support him in that fashion. Looking forward to the weekend. Big Manchester United fan if you've been listening to the podcast for a while. Hopefully we can get some good wins this weekend because our team is the bottom of the league, man. We're going down like the stock market right now. So, but it's all good. All good stuff.
Well,
No
hey, then
complaints.
you guys are going to bounce back then, right?
Yeah, exactly. That's the goal. No pun intended.
Good stuff, man. Well, welcome back to the podcast. Pierce, how are things going in Southern California?
They've been rainy and cold for the last 4 or 5 days, so Californians don't know how to act. But other than that, man, everything's all good. Just dealing with the house remodel and hanging out and excited to give some education.
Awesome stuff, man. I'm looking forward to it too. Yeah, it's been rainy here in Washington, so I definitely feel that. But I think unlike California, we're kind of used to the rain. Pretty much rains here nonstop for like 8 months out of the year. But yeah, makes us look forward to the summer months. That being said, so yeah, let's go ahead and dive into the current market dynamics. It's been pretty choppy the last month, and really what's interesting to me is just how quickly things can kind of shift, like how quickly sentiment can shift. Because if we even think back to just a little over a month ago, everybody was rushing towards the stock market. Like everybody wanted a piece of everything that was going up in value. Everybody was looking at Nvidia, some of these big tech stocks. And then, of course, the minute things start to flip, as soon as that seed of uncertainty starts to kind of show its head in the stock markets, things kind of start to quickly flip the other way. And what I typically see is, unfortunately, especially if somebody is new to the markets, maybe they don't have quite the background or the experience or maybe even the education. Is we tend to see a lot of long-term selling mistakes during moments like here, during moments like this exactly. And the smart investors, they reframe how they see moments like now, and we're gonna definitely dive into that a little bit deeper. But I'm curious. Maybe Bafi or Pierce, like kind of what you guys are seeing in the markets or how you're kind of feeling about everything going on. And, of course, there is naturally a lot of uncertainty. Every market crash kind of has a seed of uncertainty. The only reason people sell, nobody sells just to sell because they feel like just a random selling urge. Like there's always a reason, like some sort of seed of doubt that kind of pops up. But I'm curious, Bafi, like maybe tell us how you're kind of seeing things kind of unfold and how you're reacting to things going on.
Yeah, no, absolutely, man. I think, with the start of the year in general, we came in really hot, right? Markets was at all-time highs, and with the new administration, it's expected for, the business environment and regulations to be a little bit more um, favoring when it comes to businesses, right? And so I think there was a lot of momentum coming in there, and obviously over the last month or so, we've taken quite an interesting pivot. And obviously, clearly the tariffs is a hot topic. That's, I would say, kind of leading the fear, at least on the surface level, right? It's the newest thing on top of everything else. So it's really the tariffs between the U.S., Canada, Mexico, China as well, and EU. The European environment is starting to kind of, you know, join the party, unfortunately. So it does create a lot of friction within businesses and trade globally, and how citizens and individuals will probably end up paying more for everyday goods and services and things of that nature. So that's interesting to see. And obviously, Russia-Ukraine, war is more of a underbelly that's been, ongoing for a while. So that does make things a little bit tricky. I think earlier this week we had some interesting stuff that came out as well, right? The CPI, Consumer Price Index, came out, and that came in quite healthy. Unfortunately, when the PPI came out a day or two after that, that was more the opposite. So we've seen a lot of swings and a ton of volatility over the last few weeks, but and a lot of sell off in the short term too, right? Some people are just a little bit fearful, thinking things will get worse, but I think from like a business and companies earnings perspective, there's a lot of really good foundational pieces there. Unemployment ticked up a tiny bit, but even with that, businesses and everything is fundamentally quite in solid shape. But a lot of nervousness all around, a lot of fear on social media. And I'm glad that, there are platforms and systems and things in place, such as, our podcast here to help educate people on how to navigate this, right? Josh and I and Piers a bit has been through some of these cycles and up and down. So correction territory right now, you should be excited unless you are maybe at retirement age, then it's a little bit tricky depending on how much you have saved up already. But if you have time and decades, you should be excited about this. So I'm enjoying this actually, because we haven't seen a nice dip like this in a while, and it can continue or it can kind of, you know, snap back quickly. Nobody really knows. The professionals don't know. Nobody knows, right? So I've been able to take advantage of the dip here a little bit. Got my annual bonus earlier this week, so I did not even let it breathe in the checkings account, guys. Like of course, I kept a little bit for myself for some fun and enjoyment because I've earned that, and then the bulk of it, I just sent that thing right to work. And so been able to buy the dip a bit, and so far today, Friday the 14th, market has been a little bit more positive because there hasn't been a lot of tariff or new tariff counter counter percentages on goods and products and stuff like that. So I hope people are learning and understanding why it's so important to diversify, to be educated, and understand your risk threshold. And right, because and again, it boils down to making sure your foundation and the fundamentals are on point. Because when that's on point, you can take advantage of these opportunities and you weather it much better from a more um, competent psychological space versus being scared and end up missing out on some great wealth building opportunities. But yeah, enough of my TED talk. That was my little rant.
No, a great breakdown. I love it. And I do think it also it highlights a lot of the principles we talk about on this podcast all the time, just having a long-term mindset and most importantly, understanding what you're investing in. Because it's a lot easier to keep the noise or maybe keep the long-term vision when you understand the businesses that you're investing in. Like when you know that the companies you're putting your hard-earned money in have the talent and resources to adapt and kind of be more flexible during the uncertain environments, it's easier to kind of stay the course compared to when you're only investing in something because somebody tells you it's going to go up, or you read a tweet or see something on Reddit where it looks like something's a good investment and you buy it just because you expect it to go up. Well, naturally, when things get a little choppy, it's going to test your conviction or the reason you're investing to begin with. And if you haven't taken the time to do the homework, like 5, 10 hours of understand what you're getting invested in, it's a lot harder to stay focused and level headed during the uncertain periods like right now, because naturally, the whole reason why the stock market is selling off is because the future is a little bit uncertain, right? Like there could be some big changes in the business environments, and that's anytime there's a seed of uncertainty about the future. The stock market, first off, investors don't like uncertainty. And because investors don't like it, the stock market doesn't like uncertainty. So, like, as soon as that uncertainty starts to kind of pop up in people's heads, that's when we tend to see some of these massive, discounts or sales, if you want to call them that. Long-term investors, that's typically how we view them. But like even a quick review, like if we just look back in time, like even just the last 5 years, like some of the recent corrections we saw, like in 2023, the bank failures. If you remember when Silicon Valley Bank went under, there was a lot of uncertainty about the future of the banking sector. Like it's not every day you see bank systems just start to fail. So like naturally investors start to be like, what the hell's going on? Like how's the future going to unfold? But I do think like one lesson from just that example, or we'll go through a couple more, is businesses are a lot more adaptable than people think. And although it could be choppy in the short term, it's I think it's important to remember, like if you're investing in quality companies, especially something like the S&P 500, like these companies got billions of dollars of resources and talent to maneuver through difficult business environments or transition in a way that benefits them. I mean, they're literally experts at finding profit. Like if these companies are good at one thing, it's finding ways to maximize profits and maneuver through difficult, uncertain times. For example, like even the COVID pandemic, that was a huge one. We're running up on about the 5 year mark since the March 2020 crash, where we saw stocks just plummet. And I mean, just think back for a second during that moment. Like maybe some of you were investing. I was investing. I know Bafi was as well. Like, there was a lot of uncertainty when all of that was going on, right? Like the economy looked like it was just going to completely. First off, it was freezing up. They were literally closing down the economy, and so naturally, you're just like, if you're an investor, you're like, these businesses are going to zero. Like everything's collapsing. There was so much uncertainty, and it's very counterintuitive. But it's moments like
Right.
even these last couple of weeks, or when the fear's at the highest, that it's counterintuitive, but it's actually the best time to start looking at investing, like continuing to invest and scoop up these stocks at discounts, because when fear's at its highest, the market overlooks any positive aspects, like any positive aspects. It becomes blind to opportunities because all it's focused on is the fear. So it's counterintuitive, but if you take a step back, and I mean, it's not to dismiss like some of the uncertainty, like the uncertainty is real, like it's legit, like it's real uncertainty. Nobody really knows how it's going to play out. But at the same time, if you take a step back and think about it from a long-term investment perspective, these are the moments when a lot of great deals or opportunities start to pop up.
Yeah, dude, that's
Absolutely,
great.
man.
Oh, go on, Buffy.
No, absolutely. Quickly, I think there's two things, two caveats or variables that's happening now that I actually forgot to mention as well. And one of them is a slight brewing concern of like potential government shutdown, which I don't think is highly probable, but it's still a slight concern there. And then just the U.S. debt levels, along with the interest that's associated with those debt levels. I think that's something that's becoming a little bit more mainstream, where everyone is paying attention to that number a bit more. So it's kind of interesting to see how they navigate and cut cost, because to some degree you kind of have to run a nation economically like it's a business, right? Like your goal is to obviously continue investing in the business, increase revenue, increase the margins, and so your citizens will do better. But also your expenses and your your outflows, right? The money that's going out, the money that's borrowed, the interest associated with that, that also holds weight. So I think we're in a really interesting time in, for lack of a better word, just the U.S. as an economy and all the different countries, along with whatever this new world order is going to kind of look like for the next 10 to 50 years, whatever, whatever norm or changes is going to be happening. So yeah, I think everyone should get a bit more comfortable with uncertainty. And unfortunately, some of it trickles down to our personal lives in a negative fashion, whether some companies are going to be more cautious, right, in cutting costs. There's layoffs that's still happening. So I think, again, this all goes back to why it's so important to make sure that you're learning, one, how to manage your resources, two, always having a backup plan or at least a little cushion for yourself, And then you should always be kind of working on an escape to a better life and better contribution to life, right? It's not like, hey, my goal is to just escape from the workforce completely, ignore everybody, screw y'all. But it's like, okay, how can I also escape into better, more meaningful work, better impact, things that I'm passionate about, things that I want to contribute, right? So, um, really interesting stuff. Yeah. But Piers, go ahead. I'm interested to hear what you have to say on that.
No, I mean, it was funny that Josh said, because I haven't been said, because I haven't been investing for a very long time, and I started investing in April of 2020. So, obviously, I'm very, very blessed to say I got in on a hell of a deal since then, but I haven't seen much market uncertainty. I mean, and I feel like this is going to be a kind of a longer lasting uncertainty than what we faced before, just because of like you both said, the economic uncertainty is real right now. But it's cool because like I get to see my portfolio red, and what's been happening, kind of what I've been doing is to offset some capital gains, I've just been selling at like, some things at, a loss just to offset some stuff. So it's kind of better in my situation for taxes later on and whatnot. But I mean, it's cool just to see how this is going to play out because if you look at it historically, and I'm a big graph guy. I love graphs. I love going on Google, looking at a stock and looking at the graph for the last 10 years. And you can just see it going up. And it's just like that's kind of how the whole economy is. And to see this is, we're at a low point, and then once it goes back up, it's just going to be so much better. But I mean, I to be honest with you, I haven't really. I know this has been happening. I'm not a person who religiously checks my portfolios at all. I'm a person who just I know this shit's happening, but it's just kind of better for me just to go chill. And I looked at it funny enough right before this. I looked at it and it was a large number, and I'm like, okay, well that kind of sucks to see on paper, but in reality, it doesn't really mean anything. But yeah, no, it's been cool.
No, it's and the last point you made, Pierce, is super important because when you see the red in your portfolio, when you pull up your portfolio on your phone and you see, the negative percentage on your portfolio, you start to kind of, you start to maybe sometimes you feel the uneasiness in your stomach a little bit. But I do think it's important to call out that those losses aren't official until you press that sell button. And I know it might sound cliche, but for somebody who's been through multiple cycles and bear markets, it's the complete truth. And especially in moments like right now, when fear is pretty high, like we're at extreme fear levels. If you look at some of the sentiment calculators, so like Wall Street is uncertain about how this is going to affect the business world, how things are going to develop over the next 6 to 12 months, and that's very real. But I will say, there's plenty of studies out there, and just taking a look at market history and spending a couple of hours, maybe even just looking at some of the just the past crashes or past recessions and trying to put yourself in the shoes of how those investors were, what they were dealing with within the past. You start to realize that some of these moments, like although the fear is real, the market starts to price in the absolute worst case scenario. And one thing you don't want to get caught up in is just moving with the way everybody else is moving, like moving with the herd, so to speak. Like if you make the same moves everybody's making, you're going to get the same results everybody's getting. And unfortunately, with the stock market, most people do end up buying high and selling low because they don't really approach it with a long-term mindset or some sort of strategy. They approach it with a trying to get rich quick tomorrow mindset, and that almost always, ends badly. And the one thing I want to remind people is to just take the time to consider how adaptable not only businesses are, but also economies are. Like I know there's a lot of choppiness and just uncertainty with the tariffs. Like nobody truly knows how they're going to play out. But at the same time, I think people forget how massive the U.S. economy is and how adaptable it can be during crazy moments like we're experiencing now. And that's just something to kind of keep in mind. Like if you're kind of feeling the uneasiness kind of set in as people start to make speculations or predictions of how the market's going to play out over the next year. The one thing I want to say is, one of the mistakes I see is people rush for the sidelines. They say, I'm going to sell everything in cash, due to this, and I'm just going to wait for clarity or wait for the trend to reverse. But the problem with that is if you wait for the uncertainty to disappear, is you're going to be doing what everybody else is doing. And when the uncertainty does disappear, everybody's going to be rushing back in the markets and you're going to be buying back in when we're back at all-time highs. So like you kind of have to make the counterintuitive moves, although it's difficult to do. And I think that's why we have over 40 hours of episodes to help kind of build the understanding, the deeper understanding, to know how these market cycles have historically played out and to understand the business environment a little bit deeper and to understand these the decisions these businesses make to adapt or get around some of the difficult dips or moments that might seem like the financial world is going to blow up. So just something to kind of keep in mind as
Yeah.
especially if you're new to the investing world.
I agree, man. To Josh, and to your point, in terms of, people that might be on the sideline thinking, you know what, I'll just put the money out, I'll wait for it to recover. This is the stats on that, right? So typically the S&P 500 average return from the bottom of every bear market since 1950. Now, right now we're in a correction, but you can say it's probably going to be somewhat of a similar pattern, right? 1 month after it bottoms, meaning, let's say if it was going to be down 10% and then it's going to go back up, and it actually does go back up in that scenario, meaning when it's down 10%, when it bottoms 1 month after that, it tends to rally about 14.76% on average, right? So by the time, even just that alone, by the time you realize it's starting to pivot and change to go back up, you've already missed out on almost 15% gains, right? 3 months after it bottoms, the average is 21.03% gain. 6 months is 27.8%. 12 months after it bottoms is 43.5%. And 24 months, right? 2 years after it bottoms, on average, you're going to get about 62% gain. So imagine sitting on the sideline and what you miss out on in month one, 3, 6, 12, and 2 years after that. It is definitely a huge advantage to be able to hop in the market, take full advantage of it, and don't leave. Just keep adding more to your contributions if you have the capacity to, And Josh, I want to know if you have any comment on that, on that stat there.
Yeah, I mean, it makes sense. And really like there's a few other studies that I've seen where, if you take a look back at some of the best performing days, well, first off, if you miss, 10 of the best days over like the last 20, so there was a study that says if you miss 10 of the last or 10 of the best market days over the last 20 years, your returns would be cut in half. So think about that for a
Insane.
second. If you miss 10 of the best days, like 10 of the best rebound days, maybe the market's up 4 or 5%, 6%, whatever it is. If you miss 10 of those, your returns would be cut in half over the last 20 years. And, predicting those 10 days, you'd first off, you don't want to be on the sidelines when those days occur. And the second thing is what's interesting about those 10 days, if you look at them, is they tend to occur right during the when fear's at the highest. When people are panicking the most, when people are rushing for the exit doors because sitting in cash seems to be the safest route to go. I just want to remind you, like, there's a lot of common quotes about taking risks or risk taking in general, but I'll tell you this: nobody got rich playing it safe. Like the biggest risk is trying to avoid risk altogether. Like that's truly the biggest risk you can take. And even right now, even in the stock market, risk can never fully be eliminated in the markets. And people try to eliminate it the best they can. Like people want to, eliminate it as much as they can. And that's why diversification is important, is so like you can manage the risk levels a little bit better, something that kind of fits your personal preference. But at the same time, this is we talked about this with Steph Guild in our Robinhood episode. There's also the risk of over diversifying to the point where you eliminate some of the returns you could potentially get. Especially in times right now where what I tend to see is people, that maybe they want to diversify more, but maybe they're doing so in a way where they'll regret maybe 2 years down the road, as things kind of shift. So that's something to keep in mind, is like there's always going to be some element of risk. And really, I just personally, I think it's part of life, right? Like whether you're going to start your own business whether you're going to apply for a job that you want to take a career risk with and potentially, level up your career skills, or whether you're investing in the markets. If you try to avoid risk all the time, you're only going to grow so far. You're only going to get so far. And it's especially true in the markets, especially when fear is at its highest.
Yeah, Josh, you mentioned something that I think was really important. I want to circle back to it quickly. You spoke about, businesses being adaptable, right? And like they're gonna figure it out. Yeah, not every single business on the planet, but the ones that have the ability and the capabilities to figure it out, they will figure it out and things will progress and get better over time as it has always done, right? I think it is important to one thing I want to note here is how well people are also handling this correction in the market, right? Despite, of course, there's a ton of fear, social media everywhere, you see it, right? CNBC, whatever. There's a ton of fear and sell-offs happening. But I think it shows that people are learning, right? Especially your retail investors, your newer investors. It shows that they're learning, they're developing the right acumen, the proper self-regulation to lean towards the market and buying the dip rather than cashing out. And I think that's a big testament to a lot of the education work that we do here on the podcast and on and other individuals and businesses also do to educate, the everyday investor. And it's nice and it's fun to see that people are actually, taking heed, not just to their advice, but actually, applying it. And then in a way, it becomes almost like a positive, good virus where they also share, right, how they're applying it and post about their experience in the market and stuff like that. So it's taking root and it's being implemented. So that's nice to see. Now, don't get me wrong, right? There are some people that are panicking and doing exact opposite of that. Like Josh said, some people are going to pull out and think they could sit on the side and time the market. I'm sure you might have some friends, or even you might be contemplating of pulling out the market. And so I hope this episode does find you and strike you at the right time, at the right place, and trust the tools that you have and believe that, the economy and the global economy at large will figure out the kinks, we'll sort out its differences, and we'll continue to make progress. Yeah, I just wanted to kind of highlight that. It's really nice to see because Josh and I, we've been investing for quite a bit, and we've seen this time and time again. I would say this is probably one of the maybe the first time we're seeing people being a lot more logical and a bit more responsible in diversifying and taking heed to some of the foundational pieces that we talk about in many of our episodes. So keep
Yeah.
it up. Yeah, you're doing good. Keep it up.
No, 100%. And I do think, even if you do, like if you're sitting here with your portfolio and you're starting to realize like, oh, I thought I could handle these swings, but maybe I can't. Like maybe this is kind of a wake-up call of me not being diversified enough. Like to your point, Boffy, like these market dips or even corrections or even bear markets, they can be pretty, you can learn a lot about your investing style and your risk tolerance in general based on how, what kind of keeps you up at night during these moments, right? Because like if you find out that you can't stop staring at your phone and maybe this fear is really getting to you, then maybe you've already educated, like you've done a lot of research, you've listened, you've learned about different businesses and different indexes and different investing styles, but you're still kind of, you're not able to kind of pass through that fear or kind of let it not bother you. Then maybe that is a sign to like restructure your portfolio to be more diversified so you can actually sleep better at nights while still taking some risk, but not at the point to where it's just like completely destroying your peace of mind and your life in general. Like I will say this, especially as a new investor, because like I do feel like we have a crowd that has been, a decent sized crowd that's recently joined over the last year or so to, especially as the market's been going up, like that tends to attract a lot of newer investors. But if you're newer yourself and maybe this is like your first or second bear market or not bear market correction that you're experiencing, we had one back in August. This one actually feels a lot crazier. Like it seems like there's a lot more fear and uncertainty, mostly because the tariffs. Like that's kind of a wild card that's being thrown around. So naturally, there is a lot of uncertainty. But nonetheless, if this is your first or second correction that you're dealing with, like the good news is like after the first few, you start to kind of see what's going on. You start to be like, all right, I'm kind of seeing this game. I'm starting to see these cycles. I'm starting to not only see them, you're feeling them, right? Like the first couple market crashes or even corrections are pretty difficult to deal with. Like even if you do all the research in the world, even if you read all the books, all the YouTube videos, the first few are still gonna you're gonna feel a little uneasy no matter what. Like nobody likes to see their portfolio go down. Nobody wants to see they nobody wants to see them have paper losses, right? Like we want to see our portfolio go up. That's the whole reason why we're investing. But naturally, market cycles like they're going to occur, and really, the whole reason why we get these long-term returns is because you're kind of dealing with this short-term uncertainty, right? Like that's why the market rewards people for taking risks is because you're dealing with an uncertain future. Like the future is always uncertain. We don't know how the future is going to play out. Like we can, investing is all about making like strategic calculated moves, but still nonetheless, like we don't know exactly what's going to happen over the next 5, 10, 15, 20, 30 years. And that's precisely why diversification is so damn important because, especially with individual stocks, like you could be invested in one single company and maybe you think that company is going to be the one that takes everything home and it's going to dominate the business world for the next 10 to 15 years. But then a curveball could kind of come out of left field. Maybe it is something like tariffs that destroy that whole industry. If you're only investing in that industry or that one specific company, then it's going to be harder to rebound or to adapt to changing market environments compared to if you are diversified. Like if you're in a fund that has exposure to different sectors and different types of companies, it's going to be easier for that portfolio to recover compared to somebody who's fully invested into like one specific company, maybe especially if they're not like keeping an active pulse with like what's going on. So something to kind of consider. I think these moments are good reflection moments just to make sure the portfolio you have is something that you can actually handle. And I encourage you, like if you still are feeling uneasy, like the best thing you could do is to educate, like to learn about market cycles, to go through our podcast. We have hours and hours of different episodes. We even have episodes where we break down different indexes. Like we break down like over an hour of just talking about the S&P 500s and how it's self-cleansing and self-correcting, as well as we've broken down the Dow Jones and the Nasdaq 100. Like there's plenty of resources out there, and the best way to build confidence that I've found, especially in the beginning stages, is to educate yourself. Right, like figure out what's causing that uncertainty and solve that with learning. Like that goes a long way, as well as putting things into perspective. Because zooming out, putting things, especially the market in perspective, is important, especially during moments like now when there's a lot of fear in the social media finance space, in the traditional media space, CNBC, CNN, all these companies. There's a lot of fear headlines right now, and it's easy to forget or put things into perspective. But for example, like if we just pull up, like if you Google the S&P 500 at the time of this recording, it's currently down 3.9% year to date since the beginning of the year, which really isn't that bad, on the grand scheme of things. Like it's relatively a fluke. And if we go out a year, if we zoom out a year, the S&P 500 is up 9.4%. So I think, especially during times like right now, it's important to practice your long-term perspective, having a long-term mindset, and zooming out to put things into perspective. Because if you're only paying attention or making investing decisions based on what's happening in a 5-day, 5-week, or even a 5-month timeline, you're setting yourself up for a pretty choppy investing experience because the market's going to pull you in every other direction in the short term. It's going to throw you up and down. There's going to be, people saying things are going to go one way and it's going to go another way. Like you're just going to be battling all of these different variables in the short term compared to if you play the game with a long-term mindset. It just completely shifts how things go. And it shifts how you have to react. Like you actually don't have to react in an emotional way when you're not dependent on results over the next 5 to 10 years. Like if you're investing with 5+ years in mind, it's easier to kind of ride out the ebbs and flows of uncertainty in the short term.
Yeah, I think people should really be excited about the correction that's kind of happening now and the opportunity there because when you look at it, if people are pulling money to the side, right, they're taking it out of investment accounts and putting whether it's high yield savings or treasury bonds or whatever you want to CDs, or people are just uncertain, so they're just going to keep their cash off the side and not even go in the market to begin with, whether it's businesses like some of these big firms and so forth. Eventually, the bulk of all that money that's on the side is going to come back into the stock market, right? Because real estate has such a very difficult challenge right now where inventory is not in abundance, right? The cost and price of the average home is 4x what it was even 5 years ago. And and the mortgage rates are, and again, 3 to 4x what it was 5 years ago, right? And so there's not a gazillion opportunity. What makes the stock market unique and special is that there's virtually unlimited opportunity. All that cash on the side, most of that is going to come back into the stock market, you know? And so if you're already in it, you want to stay in it, right? You want to, by the time people catches on and they're bringing all that money back because they figured out the tariff situations, we've gotten to a much better economic status and things are going back up. You want to already be at the beach. You don't want to be the one that's now coming to the beach. You want to be at the beach with 2, 3 drinks already in. You're feeling nice. You're comfortable. You've already enjoyed the sunset a bunch of times. Everybody now is coming to join the party. And or again, you want to be in a position where you work less than you have to, right? And the best way to do that is if you're in the market already, stay in it because the opportunities there is unlimited. There are a lot more limitations in some other areas and some other asset classes. And so why not just continue feeding the money printing machine while everybody else eventually catches on? And when they catch on, guess what? It's going to make your portfolio go up even 10x. Now you're going to really feel like you're Warren Buffett and you're a genius.
100%. Well, and especially during times right now, like I saw, some of these institutional funds or hedge funds, ARK Invest, for example, Kathy Woods, like she's been buying stocks at a discount right now. It's like we're starting to see like, and I guarantee like once we have these quarterly reports that come out, we'll see a lot of hedge funds and institutions that were taking advantage of these moments because they like them. Like people, the smart money wants to buy at discounts. Like it doesn't want to buy when everything's crazily high. So the unfortunate thing is a lot of people who panic sell during moments of market choppiness, whether it's corrections or even bear markets where the market maybe drops 20%. If you're selling during those moments, a lot of times you're selling to people who are panic buying because they want those discounts. Like so you're literally giving them your assets, these assets in hopefully quality companies that you're owning. You're literally selling them at a discount. And so to Bafi's point a little bit earlier that he made, it also highlights the importance of having your financial foundation in place from the beginning. Because if you're investing before you've built up some sort of emergency savings, or maybe even like an opportunity fund, like if you want to have some cash set aside for some opportunities, unexpected opportunities, or just making sure you have your finances in order, like a budget, so you're spending less than you're making, it's a lot easier to ride out these waves when you have that foundation set compared to when the uncertainty hits and maybe there's even talks about layoffs or job layoffs. It's harder not to want to cave and exit for cash, right? Because like if you're in that scenario, like if you're in that situation, like I get it, like I understand why people would exit, run for the exit doors, especially when the business environment or the economy in general starts to get choppy. I mean, the last thing you want to do is your stocks are going down and then you lose your job and you have nothing to fall back on, and then you're forced to sell stocks at a loss to these hedge funds or institutions at a 40% discount. Like that's the last position you want to be in. And during bull markets, or like when things are going up, when times are good, when the market's pumping, like everybody rolls their eyes at an emergency funds or, building that foundation. But it's times like right now that highlight why it's important. Like these are the moments a foundation is built for. It's so you have the confidence and the financial situation and stability to not only roll through these moments, but ideally be able to thrive and take advantage of them. Like that's really where the magic happens, especially as a long-term investor. But good stuff, guys. Good stuff. I think we tackled it pretty well. And of course, just the final thought before we roll into some of the questions. If you are new to investing, this is like your first few market cycles. Again, if this is like the first episode you've listened to, like I encourage you to listen to the rest of our episodes because we have quite a bit of content on here that will help build that deeper understanding of the stock market for you and finances in general, as well as just, be patient. The first couple of market cycles are always going to be a little bit choppy and uncertain. especially even if you've done your research, right? Like you kind of, it's one thing to read about a market crash or a market dip. It's another thing to actually experience it with money. So keep that in mind as you're going through these choppy and uncertain times. That being said, yeah, let's go ahead and dive into some of the questions that we promised we would answer. So Bafi and I did it in Instagram Live a few weeks ago, and we just asked some of you like what questions you guys had, like what was on your minds, what were things you were kind of contemplating or trying to think through. So we'll go ahead and just answer a couple of these before we officially wrap up this episode. Let's start with this first one. So it looks like one of the questions we had was somebody asking, "How can I get started with small investment amounts?" Bafi, do you want to tackle this one first?
Absolutely, man. So that's a great question, and that live was super fun, by the way. Like
It was
we
fun.
had so much fun, and everybody was asking their questions, and for all the audience, everybody that's listening and tuning in, we will be doing more lives on IG over time, and so because we understand that when you're just listening to the podcast, yes, you get great insight, great information, but it's a little bit difficult to get your questions answered directly, right? So definitely look out for those lives and join in and ask your questions. And as you can see, we're answering those questions on the live, and we're also bringing them into the podcast episode. So to give you a little bit more of a thorough answer. So yeah, make sure you definitely stay tuned on those live sessions. But to the question, starting out with a small amount of money. The best part is one, you're not alone because almost all of us started out with a small amount of money. Very, very few people ever start out with like 1,000 out the gate or even 10,000 out the gate, right? So if you're starting out small, is the most important thing is to do it right more than do it fast, right? And so because you're building a portfolio and the strategy that you're building it with is really like the backbone slash the foundation for the house that you're building, which in this case your portfolio. So if you're starting off small, you want to focus primarily. I'm assuming, and this is just assuming, emergency fund is in place. You have pretty good, decent income. You manage your money well usually. Your 401k, you're funding that, right? You're doing things that are, let's say you've kind of passed that stage and you have a little bit of extra chump change you want to put in the market. I would recommend just starting with a basic index fund where there's your S&P 500, which like Josh mentioned earlier, we have a full hour episode of just breaking down the S&P 500, the NASDAQ, Dow Jones. Start with those traditional foundational models first, right? Investments first, because that will set the tone and make everything else easier when you actually have a bit more disposable income to now take deeper advantage of the market because you would already be diversified. And even at that point, if you want to kind of, take on a little bit more risk, you have the flexibility, you have the opportunity. And by that point, hopefully you've been learning and developing your education and skills of the market to be able to really understand what you're doing. So if you have small amount of money, stick with the indexes and then make sure that you're investing in your education. And the good news is for you, it's not going to be you have to spend a ton of money to invest in your education, right? That's what you have this entire podcast for. Right. You can really learn and invest in your education. All you need is just a little bit of time and prioritize it a little bit. You have YouTube, you have us, you have our social media platforms, you have the podcast. And so leverage all the episodes and the knowledge out there as best as you can and keep that little money working. And it's easy to also compare your portfolio to others in terms of maybe you're contributing maybe 100 every 2 weeks, maybe 100 a month, and you see some people's portfolio and is growing by like thousands, right? Don't fall for that trick because they all started out small. I started out with a $16 investment. That was my first investment I ever made in the stock market, right? Over time and over the years, it's grown to the point where now there are months and weeks where it can produce even what I make in in the whole month and stuff like that. But it takes time. So just again, go index all the way, keep learning and don't fall for the trap of looking at what everybody else is showing you in their
Hmm.
portfolio.
Yeah, especially on social media because there's a lot of distractions out
Yeah,
there.
no, nobody's gonna show you their losses anyway.
Yeah. Well, and yeah, I would say just to add to that, your first year, I would say, is more about building your investor mindset, right? Like trying to fine tune your investor mindset so that it's easier to rise above all of the bullshit and all of the noise because there's a lot of it in Wall Street's on social media and especially just on regular media as well. You're going to hear it all. So building your investor mindset takes time. And to Bafi's point, I think without a doubt, starting with just simple index funds, first off, it's going to get you in the markets. You're kind of dipping your toes in the markets and you're going to get familiar with market cycles, right? Like you're going to get familiar with the ebbs and flows, kind of thinking it like the market's breathing cycles or whatever you want to call it, whatever analogy you want to use. Like the sooner you can get used to the ups and downs and the swings, the better you're going to be off as your income ideally increases over the next couple of years. And when you come into larger sums of money, it's going to be easier to invest that money ASAP when you've been building your investor mindset with those small amounts. Now, not only that, like, I mean, I started kind of like Bafi. I started with, I think it was like, once I got consistent with it, I started with just $20 a week. Like that's all it was. It was very small amounts, but although it was small, I would say the best thing that it was doing was just getting me to make investing a habit. So then once my income did increase, it was a lot easier to, just simply add more money to the market. Like I was excited to do it because I saw what those small contributions were doing. And I saw like, they were able to withstand some of the corrections and crashes. And I was like, all right, if that small amount of money can do that over like maybe 3 to 5 years, then let's see what this big money can do for that, And so it's easier to kind of build that confidence when you come into more money down the road, when you actually just get started. Although it might seem like that small amount of money is meaningless and it's not going to do anything. First off, it's going to build that investor mindset, but it also is going to contribute to your long-term gains down the road. Like, I think people underestimate the small amounts. Like, for example, even just $10 a day. Like, I know this is a little bit larger of a investment amount. It's like that'd be like $70 a week. But even just $10 a day over 15 years, based on the stock market average return of 10% per year, you'd be looking at $115,000.
It's a pretty
You know,
penny.
that's a pretty penny. That's a nice one right there. And of course, like just putting $10 away, right off the bat, like that seems like it's meaningless, like it wouldn't do much. I mean, most people spend $10 a day easily, like without even thinking about it. So, just imagine if you started with that and actually got consistent with it, made investing a habit. Like that's really half the battle because even when you do come into these large amounts of money, like maybe down the road you get a raise or you get a promotion and you're starting to make some extra cash and you have more disposable income, if you never master the discipline of being consistent with investing, it's going to be just as difficult to be consistent with larger amounts once you have that money, even if it's the extra money. Like that's the habit of investing is fundamental. And I definitely think it's overlooked when people are just beginning, even
Yeah.
with small amounts.
I agree. I mean, look, even in just the people's personal life and consumption, right? Netflix alone is like $17 a month, and the average person has like 6, 7 subscriptions. That adds up to hundreds of dollars a month. And so, if you can see the value in paying for entertainment in that aspect, right? You should also be able to see the value, or at least, bridge the gap there and seeing the value and knowing that, hey, yeah, you can have fun and enjoy entertainment, which is good, but you can also at the same time, right, have have a similar amount of dollar value kind of go to work for you on your behalf. So you can have both. You can have your cake and eat it too, right? The amount is not necessarily the most important piece. Obviously, the more the better. But I agree with Josh. Building the habit and getting that exercise in is gonna help you seize the opportunity, especially when your income gets bigger, right? If you don't invest little amount and you wait for big amount, forget it. You're already missing out if you're not investing the little amount. And when you do get the big amount, this is saying more money, more problems, and it is very, very true. You'll be shocked, right? Right now, if you're not making a ton of money, yeah, there's still a lot of problems that you got to figure out and solve. But I can promise you, let your salary double today. Your problems will double today as well. So definitely get that exercise and the muscle going and building that habit.
Yeah, great question though. Let's go ahead and jump to the next one. So we have one. This is a good one, and it's what should I do if I don't have 5 to 10 years to wait? Should they invest? This is a good question, and I'll go
Wow,
ahead
that's a good one. That's a heavy one, but I
and
want to hear what you have to say, Josh.
yeah, no, it's a good one, and just due to the uncertainty of short-term market dynamics, like even think about what's going on right now, right? with the uncertainty we have with things going on with the tariffs and the trade wars. You know, I tend to say if you can't with if you can't put your money in the market for 5 years, at the minimum 5 years, I would avoid the stock market altogether. And the reason why is just the short term is just too uncertain. Like we don't know how things are going to play out over the next couple of years. And even if things drastically change, I'm a big advocate that the stock market is, capable of correcting course, especially these massive businesses. They have the resources to adapt to business environments. But if a big event strikes the market, like sometimes that could take a couple of years for businesses to adjust and shift their strategy to actually get back on the path to a sustainable profitability. And the last thing you want to do is to invest money that maybe you need in a year or maybe you need in 2 years. Like so for one, I would not touch anything in the stock markets with if you need the money within 5 years or less. Now, if you're in that 5 to 10 year window, now you're starting to get into the point where even if the market did crash next year, you can kind of withstand maybe some of that short term turbulence. And it might make sense to be in more of a diversified fund, like an extremely diversified fund, like maybe a total world market where you get a little bit of everything. Just because, if you're needing to exit that cash within, 5 to 10 years, you're not going to want to take any like crazy aggressive investing approach. This is at least my opinion. And so you'd want to be wise with like where you're putting that money. But really, like I would say just kind of the way the person asked it, like I would probably just keep it simply in like a high yield savings account, maybe CDs, money market funds. You're going to get a little something. Right now, what is it like right around 4%? So you'll get a little something for the money. It's not going to be anything crazy, but if you don't have the long term 5+ year mindsets, you're kind of playing with fire, in my opinion. You want to be careful with like how you approach the markets. Like on one end, especially when you see the market going up and everything's looking good and everybody's making money, it's maybe you have like a couple grand that you're saving up for a house down payments, and you're like, well, this could get me there a little faster if I throw it in the markets. But the last thing you want to do is to put money that you've worked hard for and set aside for a specific goal, throw it in the markets, and then a curveball gets sent out where tariffs are issued and the whole market freaks out and panics and everything crashes, for a little bit. And you're kind of left, where, you need that money and you need to sell. And then you're forced to sell at a loss. And like, I don't want to see anybody in that position, especially people who listen to this podcast. So yeah, that would be my take is, yeah, anything less than 5 years, don't touch the stock market. Stick with something simple like a high yield savings account, money market funds, CDs, just so you'll still earn a little bit, but you're also not going to take the risk that is going to destroy whatever goal you have set for that money.
Yeah, Josh, I mean, you hit it nail in the head, right? High yield savings, money market, um, CDs, stuff like that, because you don't have the luxury to take on certain risk and volatility, right? The only another thing you can maybe take advantage of is like short-term treasury bills, which is, government-backed low risk investments with short durations that offer some decent return, right? And it's difficult. There's definitely some things you want to avoid. And the first is high volatility assets, right? Josh highlighted that really, really well. So stocks, crypto, or speculative stuff. You don't, this is not money you can afford to lose or play with, depending on certain situations like real estate, private equity. But I will say with real estate, it really varies and depends on a lot of things, right? For example, you might not have 5 to 10 years to invest. Let's say you're a parent, but let's say you have like a son or two kids that are grown adults, right? And they're making, decent money or they're doing okay. There's an opportunity for you guys to actually move and think as a unit, right? Like maybe you can kind of combine, get something, whether it's like say a two family or something like that. You can live in the bottom, rent the top, right, to kind of help supplement some of these things because unfortunately there's not a ton of options or opportunity, especially if you haven't saved much already to begin with. It's like you're gonna have to figure out lucrative ways or maybe creative ways to kind of problem solve a little bit to where your cost of living or your financial needs are at least met a little bit, right? Because it's such a tough spot to be in, and that's why we we try to encourage people as much as possible when they do have the time, have the years, have the physical strength to actually work, right? And be able to put something aside. We try to encourage that the best. But I think Josh really touched on this perfectly. High yield savings, money market, short term treasury bills, and CDs is really your safe bet if you don't have at least 5 years.
Good stuff. Good stuff. Got a couple more questions we'll tackle. This next question is an interesting one. And it is if you have $30,000 in student loans with 0% interest, first off, that's nice, 0% interest. Is it wise to use $30,000 of investments to pay off the student loans? So there's a bit to unpack here. And I, we might have different answers. So, Pierce, do you want to take a stab at it?
I mean, if there's 0% interest on a loan, I mean, what's the rush to paying it back? I mean, that's kind of my thing. I would just throw the money in investments and let, I guess, that $30,000 you're throwing into investments somehow roll into paying that back. I mean, that's the thing. 30, it's going to stay it flat at 30,000, then so be it. I mean, there's no interest on it. That's pretty insane. I mean, is that even I don't, I'm sorry, I'm very uneducated with student loans. Is that even possible to have 0% interest?
I'm guessing so. A couple of things, like it's hard because like it'd be nice to be able to ask a couple of follow-up questions here to
Yeah,
get a
no,
better answer.
absolutely. Absolutely.
But a lot of the times, the 0% interest, it could be something on the lines. Maybe they're in the save program,
Oh, okay.
or it could also be that they're still enrolled and the interest doesn't typically start to hit. I believe if until you actually graduate, then the interest starts to accumulate. At least with the private loans or public loans, government loans.
Right.
The private loans, I think they start right away.
Yeah, they don't
But
care.
yeah, they're getting that cash. But so we'll just take the question at face value. Like if you have $30,000 in student loans and there's 0% interest, I mean, I'm guessing like, if it's only for a couple of years, I would say, and then like let's say in the scenario that it's $30,000 for at 0% interest for like 2 years, and then it goes back to like 7% interest. I would probably still start to kind of chip at it a little bit, like especially if it's at 0%, like you can kind of get that out of your life pretty quickly before that interest starts to accumulate or starts to hit your financial situation. But if you're at $30,000 of student loan debt, like indefinitely at 0%, then like obviously that's a no-brainer to keep that money invested, right? It's really just a math question of like if you can borrow money at 0% interest for like 10, 15 years, then it makes sense to invest it, right? Especially if it's that situation. Like I wouldn't pay down debts that is at a 0% interest rate for like a long-term time frame. Now, if it's probably this scenario where I think it's probably likely this scenario where that interest is going to kick in like a year or two, then that's a little bit different of a situation, right? Like if the interest is going to kick in where maybe the interest goes to like 3% at 30,000, then you could technically get away still investing and, just kind of paying that off slowly but surely. But there's a lot of like variables that we'd have to kind of gather to like give a good answer. But yeah, I don't know. What do you think, Bobby? What's your thoughts on
Yeah,
this?
I'm leaning towards that same camp, man. If of course you do want to pay it off, or chip it away, and when you have an opportunity with zero down, I wouldn't recommend garnishing your investments to rewriting your investments to then pay it off, right? Because first and foremost, if you sell the investments, you're gonna pay taxes on it anyway, right? So
That's a good
if
point.
you sold sold the investments and now you got to pay taxes on it, which you would lose depending on the situation. If it's a 30K you're trying to pay off, you're probably going to lose a few thousands in capital gains tax, right? There's a good chance of that. So you lose some money off the top. So leave that money, let it keep working and keep growing. Now you want to pay it off or chip it away, like Josh said. And when you have an opportunity to get it down in decent chunks, I highly recommend it. Meaning, you want to pay it off with extra income, right, or some disposable income that you have coming in, or if you get bonuses from work, right? Or like you got a new job and you got a sign on bonus or something like that. That's a good way to kind of reduce that 30K. Tax returns, that's also another lucrative way to kind of reduce that 30K a little bit faster, right? And if you have a side hustle or anything that brings in extra income, you want to take advantage of that and kill it. Ideally, kill it before that interest start collecting that interest, because once they start collecting that interest is guaranteed. It's not gonna go to 2%. It's not gonna go to 1%. If it's 7 to 10%, is guaranteed liability that you will have to pay on top of that 30K. And you don't want that bubbling up. I mean, that's compound interest working for your lender and not you, you know. So yeah, I'm definitely not camp. Paid off with different money, let the investment money work, use extra money to kind of chunk it down a little faster, use bonuses, tax returns, side hustles if you have. And then if you have some stuff laying around that you can just sell and you don't need it, you don't care for it, you're never going to use it again, you can declutter that way too and get something.
All right, well, we got our final question. We're rolling right through these. Lots of good ones, and I think we've given some good context around these questions. So this next one is, should I take funds from a 401k to invest in a regular brokerage accounts? Yeah, that's a no from me. Just because you're going to get hit with that penalty. You're getting hit with taxes likely. If you're withdrawing from the 401k before 59 and a half, you're getting hit with a 10% penalty on top of
Yeah.
the taxes you're paying that. So I wouldn't do that personally. What do you think, Bafi? Are you doing this?
Absolutely not. Absolutely not. Right. And I'm not speaking, I've never done it and I don't plan on doing it. I hopefully never have to. But if you have the flexibility to not do it, don't do it. And I'm speaking from like family and people that I know's actual experience. I know people that pull money out of their 401k way more often than they should. And they're not at the age of 59 and a half to be doing that, right? You'd be surprised. Some people will take money out of their 401k to go on vacation. At least in this case, you're thinking about investing the money, is right? Because so that's good, but you do not want to mess with that money at all. Don't do it. It's not what you end up losing out of is a lot. And if you want to have a taxable brokerage account, use different type of funds and different types of resources for that because the 401k money is the last money you want to play with. That's your plan Z, right? Like you need that to work. Like that's not optional. Like you need that to do its job and meet your financial needs later on. Because guess what? It might be difficult to get to retirement or have a certain level of financial freedom with the other accounts. But the 401k money, or you'll need that to be successful. You can't play around with that. That's not the money you want to quote unquote try to invest and take advantage of certain risks and stuff like that. No, no. Yeah. Let that money do what it's supposed to be doing, which is give you a good safety net when you get to those later stages of life, and you will sleep better and find different money to invest in taxable brokerage wise. Yeah.
Yeah. Yeah, we don't get pensions anymore, so take advantage of that
Yeah, we're cooked.
401k.
We're on our own now,
Yes.
you know. And I've seen how much money people. Josh mentioned about the fees if you touch it before 59 and a half, right? And the taxes you pay. But I've seen that's not even the worst part. Think about the compound interest that you miss out on by touching it.
Yeah.
You know, and if you touch it more than once, twice, three times, what you miss out on is hundreds and hundreds and hundreds of thousands of dollars. You know, and most of us can't afford that at all.
Yep. We're going to do a quick bonus one. I want to tackle this one because I think this is important, and then we'll wrap it up. But
Sweet.
it's around Roth IRA and traditional IRA. And I made a post on this about a month ago, I'd say. But the question is it true that you can only contribute $7,000 across both a traditional and Roth IRA? And the answer is yes. So that's there's a misconception out there where some people, they'll see the traditional IRA and the Roth IRA, which they kind of think the limit's separate, where you can do $7,000 to the traditional IRA and $7,000 to the Roth IRA. You cannot do that. Like that $7,000 limit applies to both accounts. So you can think of Roth IRA and traditional IRA kind of like brother and sister. If you're giving $7,000 to the brother, you can't give anything to the sister. Like it applies to both accounts. And even if you have like multiple Roth IRAs, actually, I talked to somebody who opened up like four Roth IRAs and they thought they could contribute to each one. I'm like, no, don't do that. You're gonna get the
You're gonna
IRS
get
is
in
gonna
trouble.
yeah, the
Yeah.
IRS is gonna come after you and they're gonna penalize you every single year that you keep
Yeah.
money in accounts like that. So it's a good
Absolutely.
question. And if you're listening and this is a situation you're currently in where maybe you have both accounts and you've thought you could contribute to both, The good news is you can fix it. Just there's plenty of YouTube videos out there of like how to fix the Roth IRA account issue, or of course talk to a CPA just to kind of get that fixed. Because yeah, you don't want to double dip in those tax accounts because the IRS is going to come after you and they're going to penalize you. So
Yeah.
avoid that at all costs.
I will say I actually appreciate that question, man, because it shows a certain level of curiosity and thought processes, right? In terms of, okay, how, because sometimes there are lucrative opportunities. There are ways to
Yeah.
find loopholes within the systems, right? And so I can see where you're leaning towards on that question there. So that's actually overall a positive thing. But yeah, that's like Josh just said, that's exactly how these things work, and you don't want to get caught on the wrong side of it because it's going to create more headache than you would like.
Yeah, yeah. And like you said, there are actually interesting, like creative ways that people get around limits that are actually legal. Like the backdoor Roth IRA is one example where you can technically get away around the Roth IRA income limits through the backdoor Roth IRA strategy. That's actually something that's legit. But yeah, contributing just directly to multiple IRA accounts, like that $7,000 limit is across the board for the traditional and Roth IRA. But yeah, good question nonetheless.
Yeah,
Uh, Dude, this was a good episode. It was nice to get back, in these longer formats. We've had a lot of guest episodes like the past month and a half or so. So I've kind of missed these longer form content episodes where we've just kind of tackled a specific topic. They're always a ton of fun. Bob, do you have any closing remarks before we officially wrap things up?
absolutely, man. Well, the main thing I'll leave the audience with today is learn to be present, right? Especially if you're relatively new to the game, meaning over the last 3 to 5 years, or even just last year you just started, is be present and kind of absorb and be aware of what's happening in the market, right? Like feel it, be involved in it, like smell it, taste it, touch it. Because if you get too wrapped up in not looking at what's happening or being aware of what's happening. Of course, we always preach long-term investing, but that don't mean just close your eyes blindly and not pay attention to the things happening now,
Mhm.
because it will happen again and you will see it again and you will go through it again. The only difference is the next time, whether it's 5 years from now, 10, 15, 20 years from now, you've had that actual physical, mental, emotional experience of being aware of how these things played out, right? So sometimes the financial education piece and developing is not always about just listening to the podcast, watching the YouTube video, just reading the book. It's also learning from life itself and assessing all the things that's happening, seeing and reflecting on how you're feeling through it all, right? Like Josh mentioned earlier, you might be able to realize because of what's happening, oh, I might need to change my strategy a little bit, or I thought I can take this risk, maybe I can't. Just pay attention to those things and be present in that because it's going to help you throughout your investment journey.
100%. How about you, Pierce? Any closing remarks on your end, my friend?
Consistently, yeah, like kind of like what Buffy said, always just kind of consistently learn. Don't think you know everything. I mean, when you're younger, I mean, if you had asked me 5 years ago, yeah, I do. Life is easy. But now that I'm getting older, I'm like, damn, I don't know. I know absolutely nothing in hindsight. So just always stay open to learning and respect people's opinions and their views, and just keep on learning, man. Keep your head down and put your money to work.
Well said. Well, hey, that's a wrap for episode 45. We've covered quite a bit today, from unpacking these choppy market conditions to answering some of your questions. And I think ultimately, really, the key lesson here is to remember that market volatility, the choppiness of the markets, it's part of the game. It's going to happen. And whether we're talking about this current correction or the next one that's inevitably going to come, having a solid strategy and sticking to it is really what separates successful investors from the crowd. If you found any value in today's episode, do me a quick favor. Leave us a 5-star review on whatever podcast platform you are listening on. It helps us get this information out to more people who need it. Well, that's it for today. We'll be back here in our next episode, likely next week, and see you all then. Have a great rest of your nights. Bye-bye.
If you feel just like I do, link up, come and join this crew. Hey, I'ma go invest and I'ma watch my money double, take it to another level. With that market hustle, always play it smart. You ain't dealing with a sucker. Take it to another level. With that market hustle, I'ma hustle, hustle. With that market hustle, I'ma hustle, hustle. With that market hustle, I'ma hustle, hustle. With that that market hustle. I'ma hustle with that market hustle. Go.